Gurmeet Chadha joining in this morning on Talking Point. He's managing partner and CIO of Complete Circle. Gurmeet, very good morning to you. I mean, it seems like markets start recovering from one policy announcement and then another one comes in. How are you looking at what the RBI has put out over the weekend in terms of lending norms for brokers? Clearly, the stocks taking a beating, but with a slightly longer term view, do you think that this is a necessary stick?
So, Tamanna, hi. If you see, there has been a synchronized, coordinated view of the government on reducing, the speculation linked to FNO. I think our cash to derivative ratio is even twice that of US. At some point of time, this is impacting, the general consumption also in a way. In my circle, for example, I know so many people who are, whether it is domestic help and security guards and drivers who got into this and to get out of this have actually taken digital loans. So what they are basically trying to, and obviously the kind of volatility we have seen in the market. So it started with STT hikes. They've basically now gone after the prop book essentially, which contributes to the larger volume. The MTF book will also get impacted. So brokers like, for example, Angel Broking and others, and maybe to a certain extent Novama, where bank lending is an important part of MTF book, that will get impacted. I think the overall focus is to bring the speculative thing down. It will have its impact. I think the bigger impact will come on exchanges and broking houses, but eventually it is a little bit needed. I don't know if it that strict, you have to be that stringent in terms of doing it everything all together. It could be, it can be phased out, but I think there's some concern. And if you remember during our interaction in the NDTV summit in Delhi, the FM did speak about the concern they have around this, both in terms of the FNO activity as well as certain FPI flows. So obviously, retail is being made a fodder for few large hedge funds and they're making disproportionate gains. So I think overall it's a step in right direction. Manner, timing, intensity, I think we can debate on that.
Gurmeet, one is, good morning, of course, and one is that, and Gurmeet, belated happy birthday, by the way.
Thank you.
Now, the point is, one is that there is a, how do I say, this follows a long-term trend of what the RBI and the SEBI, etc., and the government is trying to do, so on and so forth. Two is the immediate impact of this on specified players. Where do you think the first hit comes in, and is this going to be a one-off impact or could it be a sustainable hit?
It could be more medium term. I don't want to say whether it is sustainable or not. So, for example, exchanges where FNO is large part of the volumes, and prop desk is, let's say, a large part of the volume that comes down, it does have an impact. So maybe a little bit of a high multiples exchanges enjoy, like BSE, could come under a bit of a question. I'm not saying it will de-rating will happen. We'll have to see how volumes because it effectively comes into play on 1st April. Second, a lot of listed brokers do not have that kind of bank exposure in the MTF book, as well as the prop exposure. There are a handful of them. So listed brokers may not see big impact. So for example, Angel reacted because in MTF book, bank funding is a large part of it. So there'll be specific reaction, but brokers listed, larger ones, will not have that kind of impact. Obviously, increases capital intensity, more working capital requirement, pulls down the return ratios a little bit. So valuation multiple can be in question. I think who will gain is probably the AMCs, where you have managed products, mutual funds, where the fee is more recurring, fixed, annuity based. If you see, they would not see any impact, actually would gain. So lesser FNO would actually mean more flows into regulated products like MFs and SIFs, etc. So I think the AMC's gain, the wealth management, it's a little bit of neutral, and it is negative for brokers and exchanges in the near term. And Neeraj, this cash to derivative ratio has to come down. As I said, I can debate on, whether you want to do it at once when India is seeing so many, fluctuations and FPI outflows. I think maybe it could help because, maybe, the kind of liquidity retail and prop books are providing is also responsible for what we are seeing in the market.
No, absolutely. It has to happen sooner or later. When it's happening sooner than later, that much is clear. And you might see, I mean, um, the upcoming NSE IPO is just having a spate of bad news after they've got a nod. So that's only one thing to keep in mind. Just wondering how you're looking at IT, Gurmeet, because it seems like every second day there is a new set, at least in the US markets, of companies that the investors have deemed now irrelevant. The latest was real estate consultancies, where the CBRE stock down 16% in US markets. Do you think that we're going to see a phase like that in India, or in India that pain, if at all, will be restricted to the Indian IT services?
No, it's a tough question, Tamanna, to be honest. And I've not seen any big institutions thumping the table and say, let's buy IT. So it's in the near term, I think that's something we'll have to. But I think the reaction to is assuming that everything will go wrong, and these companies will struggle to generate the free cash flows they are. And they're not probably assuming that the business will get disrupted. Any positive surprises on deal wins in subsequent earnings and commentary will actually can reverse tactically this flow. Also, if you compare this, a lot of people are saying this is Industrial Revolution 3. And the timing keeps coming down. So Industrial Revolution 1 lasted, let's say, 50 years, 40 years. 2 was, let's say, 20, 30 years. This they are saying, so the time needed for reskilling is less. So I believe that we'll have more Indian IT companies partnering this AI-led change. I will not call it a disruption. I think sometimes we tend to get overboard that every white collar job will be replaced. Organizations are complex, old. It's not easy to suddenly replace software and applications suddenly with AI in real life situations. It takes time. We've been speaking to a lot of senior IT guys. So I think there will be differentiation now. Companies who are able to pivot, adapt to this change, partner this change with some of the larger guys actually will do well. And companies who are still saying, no, no, this change is just transient and I think it will get over, I think they will see more derating. So I think mid-cap IT, especially who are IP driven, tend to do better. Even in large cap IT, you are seeing now a lot of AI related focus, especially the AI services related part. So I'm not too bearish considering the price action which has happened, but you have to be selective in what you want to pick now.
Okay. Gurmeet, the other question is, where is it that there could be a valuation bottom formation happening here? Now we know that there is a trend, and some bit of that trend has been baked in by select companies like brokers trade at, I mean, not the Grow and the Angel ones, but the others trade at a really low valuation. And those are steady state businesses throwing up cash flow, so on and so forth. Is there a bottom that could get made on the valuations of any of these players, be it wealth managers, be it brokers, be it exchanges for that matter?
Wealth management space, for example, Neeraj, if you see, let's say a Nippon or some of the let's say, I'm not call them tier two, but let's say the gold inflows have been 35,000 crores. So people who have got disproportionate flows in commodity, they gain even if equity is volatile, right? Because you get fee on the overall managed assets at 8-9 lakh crores. Now, commodities make up, let's say, a lakh crore. So something like an NAM, which is Nippon Asset Management, could gain. More AMCs will do better because there, as I said, the net inflow overall is positive. Equity might have gone down, precious metals would have gone up, and I know so that they tend to do better. So they would gain. I'm not saying there'll be a bottom there, but there are some of the tier two AMCs where valuations there's a lot of comfort, like Birla, bit of Nippon. Brokers, I'm not sure. We'll have to see because even for a grow, 80% is transaction revenue. The AMC business is small. Motilal, I think there could be some valuation comfort. The AMC business now is upwards of 1.5 lakh crore, and maybe in a year from now that would do better than the broking business. And there's more, the earnings would be more structural, less fluctuating, and they're continuously adding assets both on alternates as well as AMCs. I think valuation is very very comforting there. So you have to be selective in the entire capital market space. Exchanges I will avoid. Depositories also we'll have to see what the impact would be because the IPO action has also been slightly lesser. So that's more like a high beta play. But there are a lot of pockets, Neeraj, other than capital markets where I think valuations we discuss are like COVID kind. Look at some of the chemical names. Look at some of the
Perfect.
pharma names. Yeah. So there are a lot of opportunities.
Perfect. Okay. Gurmeet, thanks so much for taking the time out and being with us today. Really appreciate your time.